Welcome back. Most of us watching this believe in the power of data. We worship at the altar of numbers. We build our portfolios on PE ratios, Fibonacci retracements, and complex discounted cash flow models. We operate under the comforting illusion that if we feed enough data into the computer, risk simply evaporates. But let me ask you a question. If modern financial models are so superior, why did the geniuses at long-term capital management, armed with 2 Nobel Prizes in economics, implode in a matter of weeks in 1998? Why did Lehman Brothers' state-of-the-art risk models report all clear just 48 hours before their bankruptcy in 2008? And why did millions of smart investors get wiped out in the Luna or FTX collapse, even though the on-chain metrics looked perfect just days before? The answer isn't that we lacked data. The answer is that our fundamental assumptions were wrong. We live in an illusion that the financial market is a physical machine, obeying precise mathematical laws. But nearly 1,000 years ago, in Baghdad, the financial center of the medieval world, a man named Al-Ghazali saw a truth that Wall Street continues to ignore today. He didn't call it market risk. He saw it as the collapse of the covenant of trust. And when you understand what Al-Ghazali wrote in the 11th century, you realize a terrifying truth. The entire modern financial system is built on a foundation of moral hypocrisy. Today, we are not talking about morality in the sense of being a good person. We are talking about morality as a systemic risk variable, the single factor that determines whether you survive or go broke when the storm hits.
Let's start with finance's greatest sin, quantification. Modern economists and quants build models based on a core assumption. Humans are rational actors and the system is neutral. They use standard deviation to measure risk. They use beta to measure volatility. They believe risk follows a bell curve distribution. If Al-Ghazali were alive today, he would laugh at those assumptions. Why? Because Al-Ghazali understood that the market is not math. The market is psychology and faith. When you buy a stock, you aren't buying a piece of paper. You are buying a promise. The CEO's promise that the books are clean. The auditor's promise that the numbers are real. The central bank's promise that the currency you receive won't turn into confetti. Your VAR model might calculate the probability of a 10% price dip, but it cannot calculate the probability that the CEO is cooking the books. It cannot calculate the probability that the central bank will suddenly change the rules of the game. This is unpriceable risk. Al-Ghazali argued that when money and markets detach from moral standards, honesty, transparency, fairness, risk ceases to be linear. It becomes binary, 1 or 0, existence or death. In 2008, the market didn't crash because housing crisis dip. Housing prices dip all the time. The market crashed because of systemic deception. Banks packaged toxic subprime debt, slapped a AAA label on it, and sold it to pension funds. That wasn't an economic risk. That was a moral hazard. And there isn't a mathematical model on earth that can hedge against that kind of collective fraud. When you look at your portfolio today, ask yourself, are you holding real assets or are you just holding faith in a counterparty you've never even met?
Now, let's talk about the drug we are all addicted to, cash flow. In the investing world, the mantra is cash is king and yield is queen. We love assets that pay us, dividends, staking rewards, rental income. But Al-Ghazali, thinking like an economic surgeon, made a cold distinction that we often choose to ignore. He divided profit into 2 categories, productive yield and extractive yield. Listen closely, because this might be why your portfolio looks profitable on paper, but is actually rotting from the inside. Productive yield is when cash flow is generated from genuine production. You grow rice, you sell rice, you get paid. You build a factory, you sell widgets, you pay dividends. This money comes from surplus value created by labor and innovation. This is the clean blood that nourishes the economic body. But extractive yield is what Al-Ghazali warned against most heavily. This is money born from financial engineering, from speculation, or from exploiting the ignorance of others. Look at today's market. When a zombie company creates no new products and revenue is flat, yet the stock price soars and dividends are paid because they borrowed cheap money to execute share buybacks, that is extractive yield. They are cannibalizing the future to pay for the present. When you enter a crypto project promising 30% APY staking rewards, where does that money come from? If that protocol doesn't generate revenue from real users, that yield is simply the latecomers paying the early adopters. Al-Ghazali called this riba, or usury, or unjust gain. But let's use modern language. It is a legalized Ponzi scheme. The danger is this. In the short term, $1 from productive yield and $1 from extractive yield look exactly the same. But in the long term, extractive yield is cancer. It drains resources from the real economy. It encourages capital to flow into money games instead of factories, technology, or education. Al-Ghazali compared financial hoarding and speculation to a blood clot. When blood doesn't flow to the organs, production, but pools in the heart, finance, the body dies of a stroke. Sound familiar? That is the exact definition of a liquidity trap and the massive disconnect between Wall Street and Main Street that we see today.
This is the uncomfortable part. If you're proud of the money you made in the last bull run, this might sting. We as investors suffer from a disease Al-Ghazali diagnosed a millennium ago: internal conflict. On one hand, we complain about the price of gas, groceries, and tuition. We hate CPI inflation. We call it a failure of government. But on the other hand, we pray, beg, and scream for asset inflation. We want our real estate to double. We want our stocks to 3x, 5x. But stop and think. If your land doubles in price without any added utility, no house built, no business run, where did that extra value come from? It came from the debasement of the currency. It came from the fact that young workers and wage earners will have to work twice as long to buy that land from you. Al-Ghazali saw the cruelty in this. He argued to desire wealth not from labor, alpha, but from price inflation, beta, is a form of economic cannibalism. You didn't get richer because you were smart, you got richer because you stood in the right place when the flood of cheap money hit, and you are benefiting from the impoverishment of those who hold no assets. In professional investing, we have a term for this: multiple expansion. When the market rallies, stock prices rise faster than corporate earnings. Investors are paying for hope and mania, not value. Al-Ghazali warned, profit earned from the madness of the crowd is toxic profit, because when the crowd wakes up, that wealth evaporates as quickly as it arrived. Do not confuse skill with systemic leverage. If you doubled your account in an uptrend where everyone won, you aren't a genius, you were just a boat lifted by a rising tide. And as we know, when the tide goes out, we find out who isn't wearing pants.
Let's dig deeper into the nightmare of every risk manager: counterparty risk. In modern finance, we are taught that we can hedge anything. Afraid of a crash? Buy put options. Afraid of inflation? Buy TIPS, Treasury inflation-protected securities. We believe that for every risk, there is an insurance policy. But Al-Ghazali would ask you a simple, terrifying question: who is writing the insurance policy? Financial derivatives are, at their core, just contracts. They are pieces of paper saying, I promise to pay you if things go wrong. But what happens when the entity making the promise is the one that goes bust? We saw this with Lehman Brothers in 2008. We saw this with FTX in 2022. Investors thought they were hedged. They had balanced portfolios, but their assets were held on a platform built on fraud. When the trust evaporated, the hedges didn't matter because the venue itself disappeared. Al-Ghazali wrote, "Market transactions are chains of reliance. If one link is forged from lies, the chain does not stretch, it snaps." This is the risk you cannot see on a chart. You cannot use options to hedge against the moral collapse of your counterparty. When a CEO lies or when an exchange misuses user funds, volatility doesn't go up, liquidity goes to zero. So look at your portfolio. You might own gold, Bitcoin, or stocks, but do you really own them? Or do you own an IOU from a broker, a bank, or a crypto exchange? In a system where court is law or contracts are king, we forget that integrity is the oxygen. Without it, the contract is just a suicide note. Now, we arrive at Al-Ghazali's most radical insight, one that applies directly to the money in your pocket right now. Inflation. To a modern central banker, inflation is a policy tool. It's a lever to stimulate growth. To Al-Ghazali, manipulating the currency is not policy. It is theft. It is a sin. In the 11th century, rulers would clip gold coins, shaving off the edges to make new coins while keeping the face value the same. Al-Ghazali condemned this as a violation of the social contract. He argued that when the ruler destroys the integrity of money, he destroys the soul of the nation. Why? Because when money loses its value, labor loses its meaning. Think about it. Why work hard for 20 years to save money if the government can print that same amount of money in 20 seconds? When debasement, currency dilution becomes the norm, society shifts from production to speculation. The farmer stops farming to trade land. The engineer stops building to trade crypto memes. The doctor stops healing to flip houses. We are forced to become gamblers just to preserve our purchasing power. This is the moral decay Al-Ghazali warned about. It's not just about prices going up. It's about the work ethic of a civilization collapsing because the reward mechanism is broken. We are living in a time of fiat nihilism. We know the money is broken. We know the debt can never be paid back. So we speculate on everything, hoping to catch the next bubble before the music stops.
So, what do you do if the models are wrong, if the yield is fake, and if the money is melting? How do you survive? You don't survive by being smarter than the market. You survive by being independent of the lie. Al-Ghazali's philosophy points us toward a sovereign portfolio. 1. Reclaim ownership. Eliminate counterparty risk. Stop holding paper promises. If you own gold, own physical bullion. If you own Bitcoin, hold your own keys. If you own a business, own the cash flow directly. Do not let your wealth depend on the honesty of a middleman who is incentivized to lie to you. 2. Seek hard truth assets. Invest in things that cannot be printed. Governments can print currency. They cannot print energy. They cannot print arable land. They cannot print mathematical scarcity like Bitcoin. And they cannot print a profitable business model. These are assets of truth. And in the long run, truth is the only hedge against inflation. 3. The 5-year test. Ask yourself this question before buying anything. If the stock market closed tomorrow for 5 years, would you be panicked or would you be happy to own this asset? If you are panicked, you are a speculator relying on a greater fool to buy it from you. If you are happy, you are an investor holding real value. We started this journey with a story of the turkey, fed for 1,000 days, confident, comfortable, believing the farmer is his friend. Then comes Thanksgiving. The modern financial system is feeding us. It feeds us cheap debt. It feeds us liquidity. It feeds us all-time highs. But this system is detached from the moral reality of production and value. Al-Ghazali's warning from 1,000 years ago echoes through the desert to Wall Street. When you separate wealth from truth, you do not create prosperity. You create a bubble, and all bubbles burst. Don't let your financial future depend on a system you cannot trust. Step out of the casino. Find the value. Own the truth.